Hello, everyone, and welcome to your Glassnode on-chain report for week 3. I'm your host, Checkmate, and we're recording on the 18th of January, 2022. So as the year ticks on, we move into the middle of January. What we're really seeing is the bears putting quite a bit of pressure on the bulls. We're seeing that as prices slip, more and more coins in the supply are moving out of profitable range. And naturally, when more of the coin supply is underwater, it creates headwinds for price. And particularly the longer that it stays down here, the more it can really start to challenge those investors who are wondering, when will I get back into the black? So essentially, we're seeing the bears applying that pressure. And on top of that, there's a number of dynamics in play that speak to a very interesting market dynamic. So what we're going to look at today is some of those spending behaviors, some of the coin supply metrics. You can see in the bottom right here, we have our short-term holder supply, which is at a very, very low level. But if we'll look at this in more detail, but where we actually see this type of behavior does in fact tend to be in more bearish trends when you move into this accumulation behavior. But simultaneously, we also have this very, very hot derivatives market. We're seeing a very large amount of open interest. Funding rates went negative this week, which is starting to suggest that potentially there's some of these traders who are layering in shorts, whether that's for hedging positions or truly taking on short positions, expecting prices to go lower. And that can set the stage for some kind of a leverage flush. And remember, that can happen in both directions, both upwards and downwards. So let's jump into the charts and get started with our analysis for the week. So here we are in our week on chain 3 dashboard. This week, we really do continue to consolidate. We've seen this fairly substantial downtrend. It's got down to about minus 40% from the all-time high, currently trading around minus 35% at the time of recording. Over the course of the last week, we did actually see a sell-off. It was kind of a miniature capitulation, which we'll characterize a little bit, that occurred over the weekend that got us down to about 39,500. It's since reclaimed that $40,000 level, which psychologically humans tend to, their mental models tend to associate with these 40K levels in terms of strength. If it's above and below, it can kind of set that kind of bias for the overall market. So we're currently tossing with about 41,000 at the time of recording, but very much in this consolidation. The market's trying to work out, with all of the macro backdrop and the inflation and Fed changing their policy to a more hawkish stance. There's a lot going on in the macro picture, and Bitcoin is really responding to that. So, as a free and global market, we're essentially seeing the whole world responding to all of these different elements that are occurring in the macrosphere. Now, we mentioned in the intro that the bears are putting on the pressure, which naturally makes sense. As price falls, we're going to see more of these bulls start to step in and really have to defend their position. And we can really see this in the percent supply and profit metric. So what we're really looking at here is how much of the coin supply is currently holding an unrealized gain, meaning if it was spent based on the price when it was last spent, if it was spent today, it would essentially be at a higher price. So there is a profit being realized by the owner of that coin. Now we can see that during the May through to July period, we had a lot of chopping around, and we eventually bottomed down here around 70% of the supply, or just shy of that. 66% of the supply was in profit. Now the flip side of that is that means that 34% of the supply was underwater. So we can see that the bulls did actually step in and defend this level. So this level was able to be defended by the bulls back in July, late July. And what we then saw is this very large bounce. And note, when you get these large step changes, price really only broke above the top of the entire range. So we're here for about 2.5 months. Price breaks above that range, but all of the supply that was sold from the top down into this zone was then suddenly in profit. So when we get these very large jumps in our percent supply and profit, and remember, this can happen in either direction. If price fell from that point, you would see the same. A lot of those coins would move into a loss. But what we can really get an estimate here of is how much of that supply was reaccumulated, how much of it changed hands and is now owned by somebody else. Now, what we've seen over the course since our $69,000 all-time high, we've essentially seen this gradual grinding lower, and we've brought it down to 69% of the supply is currently in profit, which means on the flip side that 31% of the supply is currently held at a loss. So what that speaks to is a little bit of a top heavy market. There's a lot of coin holders. 30 odd percent of the supply is non-trivial. And all of these coins were accumulated in this top zone up here. There's going to be some that existed from this previous high up here in April and March, but most of those coins, by and large, were actually redistributed down in this phase. So a great number of these 30% of total supply that's currently underwater were more or less purchased in the last couple of months. So it does show that there's going to be recency bias. People have recently purchased these coins and they're currently underwater. So that is going to create some headwinds for prices moving forward. Now, simultaneously, when we do get a break in whether up or down in either direction away from this consolidation range, we will likely see some kind of large vertical move either up or down in this metric that will help us understand just how many coins have been reaccumulated in this zone. So when we start to get a lot of, you can see here, lots of volatility, that's a good sign that coins are being moved with price. So people are essentially accumulating in that level, and therefore there's a new cost basis being formed there, a demand zone. Or if it doesn't really start to get that choppiness, we don't see all of those coins moving down there, it can tell us one of two things. Either all of the buyers up here are actually very strong hands and they have no plans of selling, or if we get some kind of move up or down, maybe that's their signal. If it goes down, they may panic and sell. If it goes higher, they may be willing to just take the exit. So it is going to be a little bit challenging, and it's something we have to pay attention to over the coming weeks. Now, another interesting one is our percent of transfer volume. So of all the coins that are moving, how many of them were in profit as a proportion? Now, what's quite interesting here is almost the reverse of psychology or market psychology. What people's brain tells them to do in markets is quite often the exact opposite of what was the right decision. So we can see this in things like funding rates. We can see it in short-term holder SOPA. Generally speaking, we get large losses being realized at the exact bottom, and we get large people who are essentially buying the top. We see these behaviors over and over again. So when we're looking at the percent of transfer volume in profit, very low numbers means that most of the coins that were on the move were realizing a loss. They were purchased higher, and they're, in, for want of a better term, selling the bottom. Now we can see a very, very low value here, which again is that selling the bottom at a loss here in March 2020. We saw these spikes here as people were kind of coming to terms with it after that March 2020 sell-off. It was quite a challenging consolidation period. People weren't sure what the economy was going to do. So there was a lot of these days where people just really weren't sure and essentially sold before the bull run. We saw it again at the very bottom of the first correction in January. July, we had a very, very low print down here at 40%. So that means that 60% of the transfer volume that day was realizing a loss. The vast majority of people spending sold the exact bottom. Now, here we are during our sell-off to 39,000 this week, and interestingly, we came down to 40%. So again, it kind of speaks to this fractal of it almost feels like a capitulation style event. Now, to add a little bit more flavor to that, if we look at our realized loss chart, I've got a 7-day exponential moving average here to really, when you put an exponential moving average on, whereas a simple will smooth it all out, the exponential heavily weights what happened yesterday and then a little bit less weights the day before that. So we're trying to emphasize recent history, which is why you'll see me use exponential moving averages when I care about things that are happening almost on a more immediate basis. I want to smooth it, I want to take out the daily noise, but I also want to see what's happened most recently. Now, what you can see is during that $39,000 sell-off, we had a spike in our realized losses. A whole bunch of people moved their coins at a loss and essentially had a miniature capitulation. Now, this was not quite where we saw back here in the May and then again in the June sell-off. These were very, very large capitulation events, over 2 billion here, almost 1.5 billion on this day. We had one such event during the December 4th major sell-off that was over $1 billion in a day. Here we're getting to around 750 million or 820 million odd. So it's still a fairly substantial day. You can see that it stands out as one of the larger capitulation events we've seen. It's certainly not a major washout, but at the same time, a lot of the spending we've seen during this correction has been more controlled. There's less panic, for want of a better term. It's a little bit more controlled, de-risking, people who did buy the top that are cashing out. We're not really seeing this major flush. This was pure panic back here in May. We haven't quite seen that yet. Now, that doesn't mean that it's not in the horizon. It may be coming that we get some major capitulation event. Again, we're in a macro environment that's quite challenging. However, it is saying that a number of folks who transfer volume really, really spiked down. So most of the coins that were on the move were realizing a loss, and we can see them capitulating at what is currently the local bottom for this correction. Now, simultaneously, we're seeing realized profits just making this very, very slow grind lower. Now, there's going to be two mechanisms behind this. The first one, naturally, as price goes lower, there's just simply fewer coins in profit. So that makes sense. Generally speaking, when coins are underwater, they're more likely to be spent because people are, panicking and getting out of their position. But what it also speaks to is that people who have much cheaper coins are actually not spending. So there's an inkling in there that there is still conviction in the market. And it kind of speaks to what I was saying before. We haven't seen the kind of dramatic fear level panic yet. Doesn't mean it's not coming, but it also means that generally speaking, a lot of the people in the market are probably closer to hodlers. And we've talked about this over a couple of videos in the past. It very much feels like it's a hodler dominated market at the moment. And we can really see this actually across a number of these two metrics. So what we have here is our supply held by short-term holders and our realized cap HODL waves. So what I might touch on is the realized cap waves first, and then I'll come back and look at our supply held by short-term holders. So with the realized cap HODL waves, the standard HODL waves looks at the proportion of coin supply relative to the circulating supply. So naturally, Satoshi's 1 million BTC, which are over 10 years old, represent a very, very large proportion of the supply as a percentage. Now, they're usually captured in purple. And you'll see here in the legend that we've got almost zero, precisely 0% for those 10-year-old coins, 0.001% at the current era. So why is it that Satoshi's coins and all of those coins from the very early days on the realized cap HODL waves have near 0%? The reason is because they had no price back then, or the price was a couple of cents. So on an economic value based on the price when those coins last moved, they don't represent a large economic weight. So whereas the HODL waves looks at the coin supply, the realized cap HODL waves looks at the realized value, how many dollars are stored in each of these different age bands. Now, the way to interpret this metric is actually one of my favorites. It's kind of like the HODL waves, but much more accelerated. You can see these much larger spikes. It kind of makes it easier to visualize. But what we're looking at is, where is everybody's cost basis? How old is everybody's cost basis based on the time when the coin was last spent? Now, what we generally look for, in the bottom here, we have these red and orange colors. These are younger coins. And I generally look at coins that are younger than 3 months in particular as fairly hot. They're most likely to come back into circulation. They're most likely to sell at the bottom, and they're most likely to realize just a little bit of profit just to get out of the market. Get my money back, get me out of here. They're the most liquid coins. Now, conversely, as they migrate up into the yellow and then even into the red bands, you can see that particularly during more bearish trends, if we look back at 2020, these are essentially folks who are buying, even though the market's been through 2018, then the 2019 bear, then we have the March 2020 sell-off. It was pretty grim back then in early 2020. These folks who are buying back then are essentially long-term holders. They're accumulators who've been thinking about this for a very long time. Now, what we see during a bull run is we see this swelling up of these younger coins. Now, what's happening here is that the older hands, people who accumulated through 2018, 19, and 20, are selling into strength. They're taking advantage of the market rallying and all of the buyers and essentially selling parts of their positions, transferring those coins to new holders, which we also see in our short-term holder supply. Note how it climbs at the exact same time. We're seeing this swelling up of these younger bands. Now, a great number of these coins bought the top and then sold back down to here at the bottom. But there's also a large chunk of them that actually bought and still hold on to them. And we're seeing them showing up now. Here in our yellow bands is our 6 to 12 months. Think about 12 months ago, we're in middle of January. So we're actually up here at a not too dissimilar price, right? And this is actually before Elon had even announced Tesla's buy. So folks who are in this yellow band have essentially held through all of this market volatility. And you can see here, it's a fairly substantial chunk of coins. And you can actually see that it's starting to expand out 1 year plus band. We're seeing a great number of these coins migrating to be older than 1 year. So a huge proportion of supply that was purchased during this run-up, here's them turning young, they've moved to a new hand, and then they've gone into cold storage, and they've slowly migrated up through the ranks. Now, where are we in our current market cycle? Well, you can see in our short-term holder supply, we had a slight uptick. Again, these are long-term holders who are spending their coins at all-time high, which is almost tradition. Long-term holders tend to distribute their coins at the all-time high, but it was only very minor. There wasn't a huge amount of coins that were sold. Long-term holders have actually held onto a great deal of their conviction, despite seeing a pretty nasty correction. So that speaks a little bit to the undertone there. However, What we did have is kind of a miniature bull run. You can see that this pattern fractal is quite similar to this one. It's like a miniature version of our distribution, and then the declining young coins, as we see these reds and oranges decline, we're seeing more coins moving from short to long-term holders. This is the hodling behavior going on, and we've almost seen a mini bull, and now we're heading back into somewhat of a mini bear, mini accumulation period. So there's a lot of these similarities that we're seeing playing out over time. We're seeing these market fractals and this human psychology and behavior playing out time and time again. Now, let's jump across to the short-term holder chart. And this is where we can really highlight some of these long-term cyclical behaviors. So generally speaking, we see these large spikes in short-term holders as long-term holders sell into bull market strength. New buyers come in with all of the excitement and the hype and all of those things, the marketing and all of the news articles going on. They're buying coins. Generally speaking, this will peak pretty close to the top. We can see in 2013, short-term holders bought the top, and then here we are in 2021, short-term holders bought the top. Now, what happens after that peak? Well, generally, a lot of the hype and the excitement dies down. And in the case of May, this year, or last year, those of you who were there for it, you probably noticed that the hype dropped off very quickly. It was almost an instantaneous flush out. We had a pretty painful experience from May all the way through to July. And during that period, we saw on-chain activity decline. We saw lots of things point to most of the folks who came just for the excitement, the hype, and the price more or less left the building. So who does that leave in the building? Well, it leaves all of the longer term holders, people who, really, really do believe in Bitcoin for the long term, people who are relatively price insensitive, right? And when I say relatively, that's compared to people who are coming purely for the price. There's some folks who will buy Bitcoin purely on an ideological basis. So what we're looking at here is a market that seems to have mostly this decline in short-term holder supply. Generally speaking, means that coins are going to longer term hands, people who are willing to weather multiple months, even years of fairly depressing price action, but they believe in the asset. So we can see here that our short-term holder supply is actually extremely low. When do we see it like this? Well, towards the end of the 2018 bear market, we saw it down at these levels. Through much of 2019, albeit with a couple of bull runs to just kind of distribute. This is not dissimilar to what we saw here, right? A little distribution and then back into accumulation mode. So I think the take-home message here, same as 2014, towards the end of the bear, just before capitulation, we see levels of short-term holder supply down here. Now remember that this is in total coins. There's been a lot more coins that have been mined over this whole period of time. So to see 3 million coins, even after we've got far more coins in the supply due to mining, on a percentage basis, this is actually very, very low. So it is quite remarkable, to be honest, to see how much hodling is going on, even with all the macro headwinds. So it's quite interesting to see that very bearish price action, and certainly signals that say maybe it is actually somewhat of a bear at this point in time, and arguably has been since May. But what we're still seeing is this very, very strong conviction from the long-term holder class. It is there. There's this undertone of strength, which is quite remarkable and interesting to observe. So it can take some time for this to actually play out. But what we're seeing is this undertone of conviction from those long-term holders. So for the next section, I just want to touch on our derivative space. So we've talked about derivatives over a couple of weeks, and there's been a lot of questions about open interest being at all-time highs and what that actually means. So let me give you a very quick overview of what I'm seeing in the derivatives market at the moment. So what I have here is our futures open interest, but we've priced it in BTC. Now, why have we done this? The main reason is because it makes it a little bit easier to see growth. Because when you price it in USD, if somebody opens a 1 BTC position, then their open interest will fluctuate as coin price changes. Their position is 1 BTC in size, but as the coin price changes, the dollar value of that open interest changes. So it's a little bit harder to see how much of the change in open interest is due to price moving and how much of it is due to people opening up a position. Now, the other way that I like to think about it, my background's in engineering, so I look at what's the disturbing force if in a leverage flush, it's too much open interest. And what's the force of the object trying to be moved? It's the weight of the market. So the other way to think about it, when you're pricing open interest in BTC, it's how much is the BTC open interest trying to move the coin supply. So it's kind of these two forces that are acting against each other. The object to be moved is the coin supply, and the overall size of the disturbing force is how much open interest is there in BTC. Now, we're not quite at all-time highs, but it is elevated. And note that we've seen this rise in open interest. A great portion of this, about 30 odd percent or more, is actually coming out of Binance as well. They're really leading the push in terms of how many open contracts there are. We've seen this expansion in open interest, and it has been climbing as price falls. Now, what we talked about in last week's newsletter is that as price is falling, it's naturally closing out people who are going long and then being wrong, going wrong, but being wrong. So it's closing people out on the way down. But as price falls, it also makes the bears more confident. They see price going down, they may add to their position, they may increase, or they may enter towards the bottom. Now, what we saw this week, I'm going to zoom in here to the funding rate, is that we had it go negative pretty much at the exact point when we sold off down to 39,000, everybody started going short. And the other layer to this has been people who've been talking about our positive funding rate. Well, many exchanges have a default positive funding rate that exists only when there's very little bias in either direction. It defaults to a positive. So some of this is actually being affected by that kind of, there's not really a bias in either direction, so it just sits there as a positive rate. So the fact that we've now seen it go a little bit negative is starting to maybe there could be a number of shorts. That concept of a short squeeze certainly remains. Of course, it's not assured, but there's starting to be pieces of evidence in this mix. Now, the other thing to note is that our futures volume is continuing to decline. We're essentially back here at January, December 2020 levels. So we've seen this fairly dramatic drip, drip, drip down of volume. Now, when you have a lot of open interest in a market that's not being as heavily traded, the force, which is the trading volume and traders putting positions on, there's not as much resistance if price wants to move. So there absolutely remains a risk of a leverage flush in this system. Now, the other thing just to note is remember back here when we were in towards the May sell-off, very, very large portion of that margin was coming from crypto backing. So that, again, similar to open interest, that crypto backing, the collateral backing the futures can also change with price. Now, we've seen since then a decline in crypto margin towards cash margin. So this does take out an element of convexivity. And if you've got your collateral, which is also losing value at the same time as a long futures position, the problems compound. Here, what we have is more stable coin collateral. So the quality of the margin is better in terms of it's less volatile. But nevertheless, we have high open interest, low volume, and some signs that it's going a little bit negative. So there is a potential that the short squeeze can still exist. Again, it doesn't have to eventuate, but there's certainly some evidence there saying that it could be possible. Now, the last metric I want to touch on is actually a bit of a special. I want to do a little deep dive very briefly onto the dormancy flow metric. There's been a lot of people talking about this, and what we can see is that it's dipped down into the green zone, and it doesn't happen very often. We saw it back here in 2011. We saw it here at the very bottom in 2015, again in 2019, in the March 2020 zone, and we've had two, one at the July bottom and one right now. So if you think about history, that's probably a pretty neat little sign, right? So generally speaking, when we look at these metrics, a nice thing to do is just to understand what actually goes into it. So what I've done is I've opened up the actual article that was originally written by Dave Puel. So what exactly is dormancy flow? Well, if we look at the inputs to it, it's a ratio between market cap and dormancy value, or dormancy times price, with a yearly moving average on there. Now, to fully understand what's going to make this metric go up and down, a useful exercise to say, okay, well, if we keep dormancy and price the same, let's just, for simplicity, let's just imagine that it stays static. What is going to cause this ratio to change? Well, if market cap comes down and the numerator goes down, then dormancy flow will come down, right? So during a bear market, we would expect dormancy flow to come down. And likewise, when we see market cap rising, so during a bullish market, we expect dormancy flow to increase. Now, the other thing we can look at is the denominator. Now remember, a larger denominator, so when there's more coin days being destroyed, older coins are coming back into circulation, the denominator is going to get larger, and that's going to, again, pull down dormancy flow. So what we see here is that, let's take the 2017 bull market, for example. Market cap is rising, so we would expect dormancy flow to be increasing. But note how it chops sideways. Why is it chopping sideways when the numerator is getting larger? It's because the denominator was also getting larger, because the higher the price went, the more old coins came back into circulation to essentially nullify that and sell into that strength. And what we see is that both the growth in dormancy was largely keeping the growth in market cap in check. So we're seeing this kind of sideways oscillation, which is in many ways saying that this bull market was actually quite sustainable. For every rise in price, more coins are coming back into circulation to actually nullify that. Price kept pushing forward, but more coins came back in, and there's just a point when that reaches exhaustion and it has to pull back. Now, what do we see during bearish trends? Well, dormancy, fewer old coins get spent. We move back into that hodler territory. So dormancy decreases, and so does the market cap. So let's again look at those in those two components. If market cap is declining, then we would expect dormancy flow to decrease. If dormancy is decreasing, we're getting a smaller denominator, then that should actually be applying an upwards force. Because what we're looking at there is we're dividing this number, the market cap, keep that stable. If we've got a smaller and smaller number, then it's actually dividing this by a smaller and smaller amount. So it's trying to push dormancy flow higher. So why does dormancy flow trigger at the end of the capitulation event? Remember, the capitulation at the end of a bear market, what we've seen historically, 2015, for example, there was a whole nother 12 months of sideways bear market after dormancy flow hit that level. Same as here in 2011. We had the bottom here in 2011, but then we had a number of months where it chopped sideways. We had the same event here back here in 2018, where you get this dip down into the capitulation event. We had 4 more months where it traded sideways, which again, a lot of people question what's going on during that time. It's quite challenging in those environments because you've just had a year-long bear market. It's triggered on the green zone. Everyone thinks that must be it, but it can still trade sideways over that time. So the amount of hodling that's going on forces this ratio to trend higher, and eventually that approaches this bull-bear threshold. So it's not because price is rising, it's because the amount of hodling is rising, the denominator gets smaller, which means that this ratio starts to pull higher. So to really close out, what are we expecting to see here? Well, we know that there's more hodling going on. We're seeing this in the realized cap hodl waves, we're seeing it in liveliness, we see it in our short-term holder supply. So what I actually expect is this to start to look a little bit like those previous events. We start to get dormancy flow ticking higher, which is driven largely by the hodling behavior. But that can mean that price could take some time. It could take months. As we've seen in previous instances, it can take months for this to actually process. And you can almost think about that like the supply squeeze is baking, but it doesn't happen instantaneously. It takes time. So I actually do expect, unless we see a big shift in the current environment, so using all the information we've currently looked at, I do actually expect dormancy flow to start to climb, which will make this thing look like it's hit the bottom. Now, maybe that's the, call it the hopium or the excitement that people need. But what it is telling us is that the mechanics behind this is that the hodling, if price goes sideways and dormancy flow ticks higher, it's telling us that the hodling is strong. Now, conversely, if we see lots of old coins being spent and this actually continues to decline, you could argue maybe it's going down to a lower level and will then bounce, but we actually need to look at the components. So pay attention not only to dormancy flow, but also to what's going on with dormancy, which is in the denominator, and look at what does that actually mean. Are we seeing old hands losing their conviction and that's why dormancy flow is falling? Or does it start to bounce because they truly are hodling and that behavior tends to remain? So thanks everyone for tuning in. Hope you enjoyed that particular little deep dive into dormancy flow. Let us know what you're enjoying in the comments. We've certainly got TXMC and others coming in and actually producing these videos, trying to get a bit of diversity in our team. So do let us know what you think. And certainly give us a like and a share on various platforms. We really appreciate it. We read all of your comments and we really appreciate it. So thank you very much for watching and we will see you next week. Cheers.